Hello again, it's Uncle Bruce from Houston, Texas, and we are going to go through another section or two of Shark Cap Table 3 Fin. We're actually going to get into the dividend side, which is a way to spike or improve the returns. Now, I want to review a little bit so you see why we're doing this. So we're going to go to section F, which is the deal-making section, and that's what we have up here right now. So look, we're at the low, we've got multiples of revenue, and we don't have any adjustments turned on at this moment. This gives us the pure and simple returns based upon actual operations, not an accumulation of profits, which is what the adjustments do, okay? You will be paid the adjustments, but I want to see the pure operations first. So here we have sale in 7 years at 3 times revenue, and I'm going to scroll through. First we have a minus 7.8 for the shark internal rate of return, then we go to the mid, it's 0.4, and then we go to 4.8. This is not exciting, folks. This is not a really good deal, but let's see if we can spice it up a little bit by using dividends. Okay, so we're going to scroll down here. And of course, you can visualize the whole deal here. And the most important thing is to take a quick look at what our liquidity ratio is. And you know that that is the beginning cash divided by that period's expenditures. And of course, it flows over into the next year because the ending cash is what's going to be the beginning cash for the next year. So I'll show you how that works in a moment. But right now, 43, 82, 74, 3, it looks like we have excess cash in 4, 5, 6, and 7. And maybe a little bit in here too. So let's keep on coming down. All right, now I just got to tell you that if you get through this first section, you don't have to go any further if you like the returns. You can go straight on and do your tab Q or your section Q and do your pitch, and then you go directly to tab 5 and 6 and make your summary. But I have a feeling that you're going to want to see how this works. It's pretty slick. Of course, everything's slick on Shark Cap Table 3 Fin. That's why we did it. We're smart guys. And you can be a great deal maker too. You got the edge over everybody when you get this tool. Let me tell you, nobody's got anything that even comes close to this. We're the only people out there that integrate your financial statements with deal making. And make a little quick business plan too. All right. So first, let's do an equity dividend deal. Now, the way you do that, of course, is you come down to this spinner and see it says equity or ED payback. We're not going to do that one yet. We're going to set it at the equity dividend. Right here, we can see the internal rates of return for the founder and the shark. It's handy to watch this. All right, so let's come down a little bit further so we can see all this. I have to make sure that we're on the screen, which we are. All right, I want to tell you a couple of important things. Along this line here, there are really 3 things that you have to do. You do not pay out of original equity. That's a Ponzi scheme, folks. That's what Bernie Madoff and Sanford did here in Houston. Bernie was a $50 billion, and Sanford was about a $10 billion Ponzi scheme. I don't want to be involved in anybody with a Ponzi scheme, and you don't want to either. Woo! Stay away from those things. Pink tells you no more distributions. And you might see pink scattered around in here. So when you see pink, you better stop. Maybe back off a little bit. Do not attempt to pay if cash is negative. You're not going to pay out all your cash. And you have to leave some cash for operations. If liquidity index is yellow, reduce the dividends. Now this is the liquidity index down here. This is just the dividend distribution right here. All right, so what we see here is it says do not dip into original equity. Next one, do not dip into original equity. Well, guess what, folks? You're not going to be paying dividends out in the first couple years anyway. Banish the thought. But we could begin to do a little bit in this third section here. All right, so let's see what can we do. So we got a liquidity index. It's okay. So let's just put in some numbers here. Now you see we got a little graph it's showing you. And I'm still looking down here to see what happens. And we're still okay. See, we still got plenty of cash. So, you might be able to go. By the way, this liquidity index here is for the beginning. This would be at the end because that's the beginning of the end of this. I can only show you one at a time, but not both. It gets too confusing. So we're cranking up. Uh-oh, we went past. We got a ready, so we got to come on down. Now, even though we could end up sending out more cash, we can't because we are taking out of the equity surplus. Let's go and do another one. So we're cranking. And I'm still down here. Oops, no, we went too far. Okay, there we are. You see we still got enough liquidity in the next period, so I'm going to keep on cranking. We're paying out a lot of cash, and we'll keep on doing it. Now, of course, the trick is that you won't see what the liquidity index is going to be in that 7th year, but we can pretty much tell that we will have enough liquidity if this number here does not go to 0. We're going to see some amazing returns by handing out. Oops, we just went a little too far. Now remember, we can hand out all that cash anyway, but it's always at the end of the year in which you sell. But why not send out a little ahead of time? It makes a big difference on your internal rates of return when you put money out first, early. We're going to see what happens right now. So let's go back up. Ha! Look at that. See this? Do you remember we had like a little tiny amount? I forgot to write it down, but I'm telling you, a 28% internal rate of return for the Sharks for the same deal is outstanding. Don't forget the power of distributions. If you can make them, do them. And you've got the tool to show you exactly what's going on. You have enough cash, you have enough liquidity, and you can see the dividends going out. All right, and by the way, it helps the founder too because he's getting his dividends. Now, these are straight old dividends. We have another kind of dividend out there, which is a little more complex, but we're ready to do that soon. So to review Section H, see this little blue guy here? That's your liquidity. It drops a little bit every time, but it's always going up, but it's coming down as you make out these dividends. These are huge dividends. And they're given out to the percentage of ownership, your equity stake. So, you know, if the shark has 50%, he's going to get half of this. And that's all calculated. All right. So you've learned a great lesson. Consider dividends to spike the returns for your equity investor. They'll love you. Yes, they will. All right. Now, let's set all these back to 0. And I'm just going to come over here and zero them and zero them and zero them and zero them and zero them. That's why I gave you these little red numbers here. You can hand do them if you want, but it's a lot quicker to do it with the spinner. Okay, folks, so let's go down now and let's play around with an equity payback system. All right. Now, what is an equity payback? Look, in Houston, we got hundreds of restaurants. The typical deal here is, let's say I have the skills to be a restaurant builder, developer, and you got the money, but no skills. We get together. You pay me a management fee, 5 or 6%, or maybe $75,000 or $85,000 a year. I build that restaurant with your money, and we start running it, assuming that we're successful. Of course, we will be. Really? Probably. And when that restaurant starts flowing enough cash beyond the minimum to keep the thing going, minimum liquidity, we start paying out. And we'll pay out to primarily the investor until he gets back maybe 1.5 times his money, maybe 2 if he really strikes a tough bargain. After that, I'm going to back in. Maybe I'll go 50-50, or maybe he goes 60 and I go 40. But there's some slice of the profits, the cash flow, that comes to me in a bigger amount than before, and he drops down. That's the deal we're going to show you how to do. It is a frequent deal. It's a preferential return. Watch how this works. So actually, we've got to go back upstairs here where we had the ED payback. Now, we have to determine, is the developer going to get a management fee of, say, $80,000 or $90,000 or $95,000 or $100,000 a year? Or if we click this little guy here, it becomes a percentage gross royalty, and it's just a percentage of revenues. Well, I don't want to work for $2,300, so I got news for you folks. I will take a flat fee of, let's be reasonable, $80,000. Okay, and that goes on for the whole deal. Always get $80,000. Actually, we have to still go back here and do the same old dividends. We obviously can't do any there. We don't really have enough money. Better go back and see what we're doing up here in the liquidity section. Oh, look at that. We actually need more money to do this restaurant deal. That's because of that $80,000. So let's go back up here and add another $80,000. That'd be, what, $320, right? Let's come down here and see if we did it right. Yeah, you see now we got some money in the bank. We got the liquidity back to normal. Okay, so to do that restaurant deal, and actually the restaurant deal may cost more because there's going to be some CapEx in a restaurant, but I'm going to leave that out just so you can see how to do the deal. We really need to talk about this. Look, if this is the amount of cash that you have, and this is the amount of equity that you raise, this is an example. There's a $700,000 capital surplus that makes up this $1 million. So that $700,000 capital surplus is available for distributions. To pay back somebody, which is going to happen first, you got to pay back $300, possibly a multiple. So the minimum is $300. That leaves $400 available for after payback. So remember, you got $700 for distributions, but first off the top is the investor payback of a 1-to-1. Now, it might be 1.5-to-1, so go $450 or whatever. So now, what happens is the after payback is again subjected to a formula. Maybe it's 50-50 to the investor and to the developer. And that's what we're going to show you how to do. It'll all be there in the calculations. So now let's go down here and we're going to set up some dividends. Well, it says don't dip in, can't do it, so now we're going to pay out some dividends. We're going to pay out some dividends. We're going to pay out some dividends. Now I can come up here, see, I'm going to keep on cranking. Yeah, okay, a little bit more. And the dividends are going to be less total because, of course, we had me at $80,000. That's chewing up cash. So we're going to keep on coming down. We're not going to give it all out. All right. So you still got a lot of cash in the bank, which is good. Restaurants are not low-risk operations. There we go. That's pretty good. We'll do one more here. We'll just crank it on down. Okay, there we go. Well, let's do it there. So that's our dividend stream. Now, how are we going to divide that up? This is to the entity. The entity says, okay, we can afford dividends of 50, 390, 480, 510, and 570 and still be successful. Now let's come down to this section here where we have it set up as an equity or ED payback. Now, the first thing we need to do is we need to kind of figure out what's the investor going to get out of this. So is it 100% of the investment, or let's make it 150% of the investment? Now notice, you see these numbers get bigger, and now it goes into the third year. So if you do 150, there's actually some payback occurring in years 3, 4, and 5. There is nothing going on in year 1 and 2 because you're losing money. You can't pay out of your equity. Remember that. Anybody, no payouts of your equity. Now the question is okay, now we've got, in this section, we've got the investor paid back. 1.5 times his money. Now, how do we do the preferentials or the after payout? Well, if we decided, this little spinner up here will say use the equity. In this case, the developer has 82% and the payback investor has 18% of the company. Or probably we'll click here and we'll use a preferential and maybe we'll set it up to be 60-40. And I'm going to make the investor get 60%. Am I ever not nice? So there it is. There's 46. It's 100%. See, they add up. So this is how much money you get in years 5, 6, and 7. The total is 440, 510, and 570. And this is just a checkpoint against these because these little guys here are the 60 and 40% of the total. And here's the total developer. So developer does pretty good. And the investor, well, he gets his 50. There's the 390, and then he gets the 304 because he's got 40 still coming. Okay, now he's back down to the 306 and the 342. Ha ha! Not bad, folks. Not bad. And we still have plenty of cash left over to run this restaurant. And if we sold it at the year end of, say, 7, we'd still have a lot of adjustments, and everybody would be happy as heck. Tell me if you find a deal like this. Okay, so folks, that pretty much does it for the restaurant deal.